Okay, so I'm going to talk about, we've kind of talked about this before, but I'm going to take a it's a very big idea and it's a very small place on the chart. And this is actually a preview of what I'm going to talk about when we meet at ChartCon. And at ChartCon, uh, it's going to be about, uh, in my case, where we put on trades, how we set stops, and if we do it in the right way, we put our trades on and place our stops in an area where there's going to be less likelihood of the market being able to go back to that place and hit your stop. So keep that in the back of your mind as we talk about this. And so here, this is one of our schematics, which I'm sure many people are familiar with. And let's there we go. So these are the areas we've talked about. This area, the stopping action of the decline. I'm not going to go there today. And then the process of accumulation, which takes place over a period of time, which can be months to years. And the accumulation process ultimately completes over here when we get into phases C and D. And this is where we want to get active with our trading. We're watching the market in phases A and B. They're very volatile phases. It's a great place to suffer volatility, and people who try to trade there often lose money because of the sudden swings up and down. But when you get over to phases C, D, and E, the stock has been absorbed, which causes prices to get dull and quiet, and this is evidence of the fact that what we call the composite operator, the very large informed interests that are building positions in these stocks, have bought up all the stock that they can buy. They've accumulated basically all the shares. The shares are in strong hands in phases C, D, and E. Okay, so here we're going to focus on really what we call the hinge or the pivot. And the hinge is that area where it gets dull and quiet, volatility comes out of it, and then it pivots up into its uptrend. And when it does that, it can be quite dramatic. Stocks can move easily and effortlessly in the direction of the larger trend. This is a very important sign, and this is a place where we want to have built our positions or are building our positions. So I'm just going to show you some examples. The other thing that we're going to talk about is this in the context of reaccumulation. So we are looking at a reaccumulation because this is what we had gone through in January. So think of this buying climax as the January peak, and then we go into the automatic reaction into the February lows, and then we build an accumulation. Many stocks have done something similar to what the indexes have been doing. And then finally you get into a period where the market has been adequately absorbed, and then it can start to move up. And so, and then over here is where our hinge, which is a great old term, classic old term from, the markets, Wall Street 100 years ago, or a pivot. Okay, now what I want to do is I want to talk about this in the context of the current market. So we have 4 indexes here. I apologize if they look a little bit small on your screen, but we are going to look at the S&P, the Dow Industrials, the NASDAQ, and the Russell 2000. And we can see here this very large pivot that in the S&P 500, where there's a very wide volatile period. Now look at this is all phase B right here. Look at the volatility. And then as we get into phases C, which is the final testing phase, and then the markup, phase D, the markup has already begun. And here we are marking up to resistance and then backing up. Well, this is what we have it here labeled the last point of support, which is an old Wyckoff term for the last place that support is found before it starts to mark up into its new uptrend. So we can have more than one of those. We can see it came up to this resistance level and then it paused. And in the pause, we have what amounts to, it's a little difficult to see it here, but this is a hinge. This is a pivot, because we had a little bit of a shakeout. I actually wrote a blog on this a couple of weeks ago before this little shakeout happened, very common. And then it turned off of that right away, and then has just marched up and out and right through this resistance area. And we can see with the Dow's behind the S&P. The Dow has its backup or its pivot right here, and it's starting to mark up, and it's attempting to get up to this resistance level. And there are higher resistance levels, as we can see, which would be at the high and at this up thrust, and here at this automatic rally. So each of these, and these are all areas you can read about in the blog, but the Dow is attempting to get through overhead resistance. The NASDAQ and the Russell, which are just stellar, have been leadership here, are at new highs. And so notice this with the NASDAQ. Look at how a low was made here, a test of the low, secondary test, a rally, and a last point of support, phase C. This is another higher low, 3 lows, second higher low, and then it rallies very well up to the resistance area and then puts in another pivot. And at this point, it resolves itself above that, and look at how easily it goes right through the resistance area, and it's up and out. The Russell's actually looking even a little better than that. So the Russell has gone up, it's backed up, very shallow backup, and this important point, this is evidence that absorption is complete. So absorption by strong hands. When a stock or the market goes down with volatility, like the solar stocks are doing today, those stocks are in weak hands. When the stocks have been absorbed and they're in strong hands for a large uptrend, then you get trading activity or trading on the charts, the footprint of the CO on the charts, that looks like these pauses or pivots that occurred near resistance areas. So here we can see with the Russell is it jumped up, it backed up, it was very short in duration, very shallow, and then turned into a nice uptrend. I completely agree with Tom that there's likely to be some kind of a pullback in the NASDAQ and the Russell. And I believe that what we're going to see is we're going to see the Dow catch up. The Dow's going to start to act well and do some catch up. It may not be able to catch up with the overall performance of these other indexes, but it is going to act better, I believe, on a relative basis for a period of time, while the Russell and the NASDAQ rest. And the S&P, I think, will also act well. Now, let's look at how far up, how much fuel is in the tank, looking at point figure charts. We do a Wyckoff market discussion webinar on Wednesday, so this is from yesterday afternoon. And Roman Bogomazov and I do this Wyckoff market discussion each week, and we cover the current markets from a Wyckoff perspective. And so what we did is we put together point figure charts of this accumulation area, and you can see here that there are some recent blogs that I've done on analyzing this area, but look at the S&P. The S&P in a conservative count of just this area, and this is the January, February decline over here. So we could eventually count this whole thing, which would be a huge count. But the S&P counts up to 2950, 2990 on the smaller count, and then look at this, 3130, 3250 on this larger count. And here is our pivot right here. So we can see it backs up where it broke out, and it backed up. We count from where it backs up, and we count from right to left, and this is our larger count. Now, the thing that I would be really paying attention to is the resistance area at this peak, which is around 2800, sorry. and then also this peak, which is at around 2870. And because these resistance areas, I do believe, will come into play. And the other thing I would say about this regarding the Wyckoffean concept of buying climaxes is that this was a very traumatic event. So we have this traumatic event where we have this rush up into a climax and a big decline called an automatic reaction, made the market range bound. And it could very well be that it remains range bound for a number of months to come. So we have a good rally going. We're going to see how it gets up to these resistance areas, and we're going to evaluate it and for whether or not it can immediately fulfill these counts. So we're always looking at the market as it is now, tape reading and evaluating its current condition. But the rally that we have is a really good rally. So, and it's acting quite well within the context of it being a really big range bound condition. So the industrials, we were talking about how they are have been laggards, so to speak. Well, we have two counts here: 26,200, 27,050, which takes us back to the realm of the highs, which makes perfect sense. And usually when you fulfill an intermediate count like this, it's going to pause for a period of time, and it's going to have a bigger backup. It'll be something akin to this, but it'll be on a larger scale. It may jump out and then back up, and that would be very bullish. So what we don't want to see is it to get up to this one of these resistance areas and then just fail. And that can happen in a big, if this is big distribution, which we don't think it is. But here's a larger count. This goes 27,700, 28,750. So this gets us to and through the old highs. Now, the other thing is that when we can get to this area, then we can go back and we can take this bigger count, which, as you can see, is substantially larger. Okay, the NDX, NASDAQ 100, we can see here that we have a count. We're pretty darn close to that now. 7,300, 75.25, and then 7,900, 84.75 for the bigger count. And look here, we can see how beautiful this this pivot or this backup is right there. And then the Russell. And the Russell is really just looks the best of all, even on the point figure counts. And there's sort of a cool thing at work here. And that is that we have a reaccumulation count here, 17 columns wide, takes us to 1815, 1905. Well, then it jumped out of there, backed up, paused, and now it's back. Another reaccumulation formed, and it's back in gear again. And notice this count confirms this count, and there's still certainly room to run in these two counts. And so this, I think, is very encouraging for the Russell continuing to be leadership. So these are the charts we just looked at. The only thing here is that there's a nice distribution count that you could take here and look at it. Did a really good job of getting the estimating the area of the lows. It had one little throw under. So those are really valuable. And so this is the same chart we just looked at. Here's the NDX on a larger scale, larger price scale. So anyway, okay, so let's see. Let's just go right. We talked about these. And so the only other thing that, let's see, how are we for time? We're in good shape. Is here's the NASDAQ composite, and here's a Wyckoffean view of this accumulation area from late March through May, into May. And it has all these great characteristics. And so selling climax, automatic rally, this sets the range, support and resistance. Then we have an up thrust or a sign of strength that takes us to the top. This is resistance. And so then we have a pullback. The last pullback in phase C, we call a last point of support. And this results in a good rally up and out of the accumulation area. And we work very hard at developing our skill at being able to identify these LPSs and tests, because these are important areas to initiate trades. So we would see that the test comes down to support. It cannot get to the LPS. This would be a good conservative place to enter a trade. Stop goes below the LPS low, and because this market is now now under accumulation and nearly complete, we expect that the risks of it going down through the LPS low are low. And so this is a very good tactical place to put a trade on, because there's a low percentage possibility of the stop being executed. And we
Hey,
can, yeah, go ahead.
yeah, I was just going to ask a question there on that
Sure.
LPS. At the moment that that LPS, at that particular time, so we're talking
Mm-hmm.
about toward the end of April, do you know that that's the LPS at that time, or do you have to see that bounce back first?
We're attempting to identify that LPS in that moment.
Okay.
And so some of the things we would look for. Now, Tom, I don't want to take too much away from my ChartCon presentation, because I'm going to reveal the secrets there.
Oh,
But
okay.
I am going to give one away here. And that is that what we would see here is a climactic decline. Now, we can't see the volume. Volume helps, and volume is very important to Wyckoff. But look at this rush down, two really big bars. Now, this is a 2-hour chart, so 2-hour bars. It goes down and to the area of important support, and then we use the term springs this low of the support area, but it's not technically a spring. But what we would do is we would wait for a good bar that reverses back up through support, and then it comes down and tests. And so we have a couple bars here where we can see that there's resistance to declining. These are an excellent place to initiate trades. There's a minor test. LPSs are typically always tested. So we look for the test, which is a higher low on a very small scale that suggests that the market is exhausted, the decline is exhausted, it's done going down, it wants to turn up, it wants to pivot up. And so this rally is really a nice rally because it happens quickly and it goes up into the middle of the range. We would have been happier with this if it had gone up to the resistance area, but we would maybe put one tranche on of the trade at the LPS if we can identify it, but we also are prepared for a bigger test. And so this test comes down and you can see that there's an attempt to decline. Volume, I'm sure, was lower here than it was here. And then there's an attempt to turn off of that, pivot up. Look at that nice tail. So it rallies up, shows that there's some good demand in that bar. And then there's a test that comes, a couple of tests that come in the hours that follow, and we would be buying that test. And so that might be tranche 1 or tranche 2 of our position. And then this rally confirms our idea that this market's under accumulation. So we have a theory it's under accumulation. So we have a position on here, maybe here, and then here. This is the pivot. This is the jump out and the backup. So this is a big sign of strength. Signs of strength are really important because look at the difference between the way this trades. It's like sideways, and it's getting duller and duller as it goes through here. Where look at the declines that precede it. They're just wicked, volatile, and show that this still accumulation is taking place. So what we like to say is we like to put ourselves in the mind of the CO and say, well, what's the CO's motive here? And so the CO attempts to bring the market back down again to see if supply comes out. They don't know how much supply is available. And when they see that there is not enough supply to bring the comp back down through the lows of the LPS or to these lows at the spring in phase B, then they go, the supply has been absorbed and there's good demand in this market, and they are buying the weakness. The CO is using the bottom of the range to accumulate their positions because they're building such huge positions. And so these these are the tests that confirm the bullishness. And so we're always judging that. And so here, we would also be willing to put on a tranche here because we can see the volatility coming out of this. And so we always are averaging up our position. We only add if our prior positions are winners. And so here we have maybe a third tranche that goes on, jumps up, attempts to back up again on a very minor scale, and then an uptrend begins. So this is all very constructive rally behavior.
All right, one more question.
Sure.
Okay, so the LPS, if you get into an initial tranche there, I can look back to those prior lows. I'm looking at maybe, where you might say, well, our initial view has changed. Things have changed in the market. Now, all of a sudden, we don't see what we had seen before. If you get into the LPS, I'm assuming that prior low would be like a stop area for you, that early April low.
Yes.
Because that you're considering to be the spring, that's your bottom.
Sure.
So anything below that would kind of ruin your theory here with Wyckoff.
Exactly. And if we have a pivot up, let's say that we are able to buy shares on the test. And if we have a pivot up, we may take this stop and move it up under here.
Okay. Now, what about, you were saying the next tranche after you show that strength in middle of May, where you make the breakout and then you go into that period of lesser volatility? You said that's a period where you would consider adding.
Yes.
What would you do with your stop at that point? Would it be all the way back down to the LPS, or would it be higher?
Yes, you always move your stop on the entire position as you go forward. And so now you can use judgment here. And I'm going to spend at ChartCon, I'm going to talk all about these tactics. So I apologize if I'm a little brief in this, but you could put a stop under here. If you bought say tranche 3, let's say you bought it here or here, this is nice because it sort of springs that prior low, or here as it's testing another higher low. You can move your stop on all 3 positions, say under here, or you can move them under here. Mm-hmm. But I would think that you would want to move your stop as you put a position on here and you turn up, you're going to put your stop on tranche 1 and 2 under here. Okay. And then you put it under here. And so the question for a Wyckoffian is, do I go 1 support level down or 2 support levels down on my stop? Okay. And we typically are always moving them up underneath prior key lows as it moves up, with the expectation is that it can't get back there.
Gotcha.
And then here, I just threw this chart in just so you could see. This is an intraday. I love to do intraday charts. I'm a long-term position type person, but I love to look at the shorter term, and all the Wyckoffian principles tend to be in force even in the shorter term. And so here you can see this is a 10-minute point and figure chart. You can cover a lot of ground, a lot of time with even intraday point and figure. You can see here see the structure. Sign of strength is here. Automatic reaction. You have phase B, and then you come down. This is an LPS, and then a jump up and out and a backup. And so you can see all the elements are there, and then you can count that. And this little business right here counts up to 8065 on the NASDAQ composite. So, and these can tend to be terrific. If you can see these in the point figure, look at how well it resolves itself to the upside. Once the imbalance of the pivot occurs, it just gets in gear and starts to go. And whether or not it even can fulfill that, you know that there's a lot of fuel in the tank for at least a short-term trade, swing trade. So these are wonderful tools for swing traders. So this is a point and figure chart. This is in a blog that I wrote a few weeks ago back in May. And here you can see these counts. And so count 1 counts up again on the S&P. It counts up to the prior resistance area above here. So you can see this is likely to, this point and figure chart suggests resistance is going to come in at that 2,800 level. And then notice this, and this count wasn't complete yet, but I was suggesting in that blog that this was the jump out, the backup, the pivot, or the hinge. And it came down one more time. So this count actually is a little bigger. And then it jumped out. You can see this also counts up to that 2,800 level.
I know we have a poll. I don't know if you're ready to maybe pull the poll up and talk about a few things.
Sure.
Yeah, why don't we go ahead and pull the poll up? The question was, and it's a good time because you talked about the outperformance on the NASDAQ and the Russell 2000, but you also indicated you wouldn't be surprised in the near term if the S&P and Dow were maybe to gain some of that ground back. So the poll that we were asking our audience was, will the NASDAQ continue to outperform the S&P 500? And 69% so far are saying yes. Only 18% say no, and the rest are unsure. So I'm kind of in the camp with the yes. I mean, I do agree with you. I think in the near term, especially with the dollar kind of relaxing a little bit, I do think that maybe some of that money may rotate back to the S&P and the Dow in the fairly short term. But I'm still, if I look out a couple of months or I look out 6 months, I think we'll look back and say the Russell 2000 and NASDAQ have outperformed over the next, say, 6 months.
Sure.
Would you agree with that, or would you disagree?
I would agree. I think always go with strength.
Mm-hmm.
I think this poll is interesting because the S&P and the Dow are clear laggards in the index race right now. And so I think it's interesting because the NASDAQ and the Russell have just shown such good leadership. And there's higher price objectives in all of the indexes, but you can see the NASDAQ on our point and figure chart was actually only 100. The NASDAQ was 100, was only 100 points away from our minimum P&F count. And so that doesn't mean it's going to go down, but it does mean it could cause it to pause. And there's more room for the others to go up. So it wouldn't surprise me if there wasn't some catch up. But in general, I agree with your statement, and I agree that the leadership is likely to persist in the long term.
Okay. Now, one of the things you and I talked about before the show, just about every guest we've had on here, and I follow relative strength very closely. Just about everybody, all the commentators writing at StockCharts, I see articles about relative strength. We've had Mark Chaikin on. He's talked about relative strength, and that's kind of the basis for what he does. And so you and I were talking about it before the show, and you were talking about how relative strength is really important to you. So I thought maybe you could take a couple of minutes and just explain how you look at relative strength and how that helps you in your Wyckoff approach.
Sure. Well, relative strength is actually the first cut for me. And so when I look at stocks, I want to know that they're outperforming, and I've been doing it this way forever, is I want to see that they're outperforming the S&P, and also that their peer group is outperforming the S&P. And I look at that on a long-term basis. So I look at a long-term moving average, and people use different moving averages. Some use 30-week, 50-week moving averages. I use 39-week moving average. And what I want to see, I hope you can see that, but here you can see that here's the Kohl's to its peer group, its industry group, and here's Kohl's to the S&P. So one of the conditions that I want to see, and get this, look at how well this works. This is a jump. Here's a small accumulation, a jump up, and a back up. So here's your pivot. So it backs up one last time, attempts to test high or low, and then it turns and goes into a beautiful uptrend, which is what we live for these. We're like constantly trying to identify this turn where the imbalance goes in the favor of the uptrend. And notice how the relative strength has been, Kohl's has been leading its group for a number of weeks. So this is a weekly chart. And then here to the S&P, it turns up and above the 39-week moving average of the relative strength here. And this is all occurring as it's jumping up and out and pivoting into an uptrend. And so here, this is really almost, it's really timely for seeing this uptrend. And Coles is saying, I'm the leadership in my group for weeks before that. So that's something that I really look at, and then expect these uptrends to be in force for months to years. And there's a huge point and figure count in Coles here. As a matter of fact,
the other thing too here is that if you look at, you don't have it on the chart here, but if you take a look at the retail or the apparel retailers, the DJUSRA, and compare that to the S&P 500, you've got one of the strongest areas of the market over the past couple of months, where we've broken out not only on an absolute basis, but we're breaking out on a relative basis to the S&P 500. This has been a very, very strong group, and as you mentioned, Kohl's is one of the strongest within the group.
So here obviously it won't show the industry comparison because it is the industry, but here's the industry to the S&P, and this is an important cut for me. When I go through and look at industry groups, I'm constantly looking at the price chart. So two attributes that I'm looking for is I'm looking for the price chart weekly to be above its moving average here, which is the case. And here we can see that the group is above its relative strength moving average. So we have confirmation of the uptrend here and here. And look at this nice backup and pivot. So it gets up to the resistance area, and notice the change in character. Big decline, a lot of volatility, less volatility. But then here, just a big decline with a shakeout type action. And Tom, look at this, a shakeout or a spring, which is something that we like to trade. We try to trade these, but we don't trade the spring itself. We trade the turn up back into the support area, which is like right along here, and then a backup. So here's the test. This is testing this. So we would either buy the strength on this turn for tranche 1 or buy this test here, and then look for strength to follow. Beautiful strength. This is a big change of character. This is a beautiful rally, and it's much better than anything else on the chart going back a few years. And then notice the backup. So this backup is shallow, dull, quiet, and it just sort of hangs out there, which drives traders crazy, by the way. But they should look at this and say, wow, this is exactly what I would expect from this group if it's bullish. And here, look at this really nice bullish bar right there. So really big volatile upward bar, comes back and tests one more time, and then it's up and out. So this is what we're attempting to do, is to identify this conversion from dull or trading volatile trendless markets to trending market. And this tells me that these stocks are in really strong hands. I love this group.
Yeah, it was great having you on here. A very, very informative session. Really appreciate you coming on, and we're going to get you back.
With 3 unique service levels and multiple data plans to choose from, StockCharts.com makes it easy to customize your account to best match your specific needs. In this video, we'll help you explore all the benefits of your membership by explaining our service levels, data plans, and pricing. Let's see how it works. To start, you'll want to choose from one of our 3 service levels: Basic, Extra, or Pro. Each service level represents a collection of features and options bundled together. If you're new to StockCharts, our basic service level is a great place to start. At $14.95 per month, Basic will allow you to create larger, more powerful charts and save them to your account. Next up is our Extra service level, the most popular choice among StockCharts users. At $24.95 per month, it includes all the features of our basic level, plus more saved chart storage and the ability to create custom scans and alerts. If you want it all, our Pro service level is for you. At only $39.95 per month, Pro includes even more storage for your save charts, custom scans and alerts, as well as faster auto refresh, historical data, and much more. For all service levels, you can choose to subscribe on either a monthly or an annual basis. Our monthly renewal option is similar to most other web-based subscription services. You pay for 1 month of service at a time, and your account will simply renew automatically each month. With our annual renewal option, you prepay for 12 months of service and we'll give you the 13th month for free. If at any point you'd like to change your service level or renewal preferences, you can always do so from the Your Account page. Now that you've chosen a service level, let's find a data plan that works best for you. Regardless of service level, all StockCharts accounts come standard with our free data plan, which uses BAT's real-time data for the US and delayed data for all other markets. However, if you want to enhance your StockCharts experience even more, you can customize your account by adding official real-time data plans for one or more of the stock exchanges we support. Similar to exchange fees, prices for each plan vary, as they reflect the fees charged by the exchanges for your use of the real-time data. We want to make sure you have the data that's right for you, so our data plans are flexible and can be added or removed at any time. Keep in mind that all real-time data plans are billed separately from your service level subscription and always on a monthly basis. Unless removed from your account, data plans renew automatically at the end of each billing month. If you do choose to remove a plan, the change will take effect at the end of the month. All data plan charges are non-refundable. To explore all our data plans and update your preferences, visit the Your Account page. StockCharts.com gives you the charting tools and resources you need to invest smarter. And now with the flexibility to customize your service level, renewal cycle, and data plans, we make it easy to find the account options that are just right for you. Take control of your investing in just a few simple clicks with StockCharts.com, simply the web's best financial charts.
I want to show you a little charting trick that I like to use for the percentage price oscillator, or the PPO. On this SPY chart here, you can see in the indicator windows I've got 2 PPOs. The first is the traditional PPO. It's the black line there, and that's the difference between the 12-day EMA and the 26-day EMA. And you can see it's above 0 when the 12-day EMA is above the 26-day EMA, and below 0 when the 12-day EMA moves below. The red line is the signal line, and it's set at 9. So it's a 9-day EMA of the PPO, and you can identify downturns and upturns in the PPO with that EMA. And the histogram is the difference between the PPO and its 9-day EMA there. You can see when the PPO is below its 9-day EMA, the histogram is negative. And then when the PPO is above its 9-day EMA, the histogram is positive. Now, the little trick I want to show you has to do with the PPO 50, 200, 0. That's the second indicator there. And what I've done is I've eliminated the signal line by putting 0 as that last parameter. So this PPO shows the percentage difference between the 50-day EMA and the 200-day EMA. And you can see that it shows as a histogram when using these parameters, and it has been positive for over 6 months, actually for over a year, actually for over 2 years in this chart. And we can see that it's currently around 3.1% difference. That means the 50-day EMA is 3.1% above the 200-day EMA. And we can confirm that by going to the annotate button there and choosing percentage change. And if you measure the percentage change from that 200-day EMA, the red line, and I go up to the 50-day EMA, there you can see we're about 3.1% difference. And so that's what the PPO is telling you. And so I like to use that longer term PPO to get an idea of the long-term trend.
Volatility is back, interest rates are rising, and the markets are headed into uncharted waters. As uncertainty grows and the tides begin to change, you need to take action. ChartCon 2018 is here just in time, with an all-star cast of investing experts and industry-leading technicians. Watch live as these pros share their charting wisdom and guide you through their strategies for finding success in any market. Your registration includes 2 days of insightful, exclusive presentations from 15 investing legends, plus complete video recordings to watch on demand for years to come. Stream ChartCon live right from the comfort of your own home or office. No need to travel, no need to break the bank. See how the experts are protecting themselves from market volatility and reducing risk in today's uncharted waters. Join us at ChartCon 2018, streaming live August 10th and 11th.
This is a brief tutorial on using stochastics. Big word, but wonderfully simple. The idea behind stochastics indicator is that as the price moves up, the close tends to stay close to the highs, or the price action throughout the day tends to stay close to the highs. And as the trend weakens, it has trouble staying near the highs. The stochastics will point this out. And the reverse is true at the lows. So as price is declining, all of a sudden it stops always closing near the lows. So not to get confused with %D, %K, %R, that type of thing, Henry Ford started with the Model A and went B, C, D, E, F, G, all the way through to T until he came out with the Model T Success. And so when George Lane and his colleagues were doing that for stochastics, they kept working their way through, and they did the same thing. They used %A, %B, %D to try and find a rhythm that worked out nicely. So what stochastics does is it takes a range over the last few days. In this case, a 5-period stochastics would say that from this point to this point is 100%, and price closed at 82%. And then that would be %K, and then %D would be a moving average of that. And it's important to remember on stochastics, according to George Lane, there is only one valid signal, and that is the divergence on %D. So you're looking for the divergence on moving average, and I'll show you that on some real live examples. So here's Apple, and I've got these stochastics set up slightly different. So this is a fast stochastic, this is a slow stochastic, and you can see that it's much smoother. It's got these whipsaws taken out, and that smoothing function is what %D is changing for us. And then the full stochastics here, I've changed the period to 14 instead of a 5-period stochastic, just to show you that it gives you smoother signals, and so it's a little easier to trade with a 14 period, and that would be the default at StockCharts. But depending on how aggressive you want to be, you might find that there's a better way to trade. So all of these signals are important, but what the big clue you're looking for here is this positive divergence where things are improving while the momentum is coming down, and you're starting to see the stock whipping around at the bottom here, usually a sign that something's getting a little more volatile and you might get a chance. So a nice trade like this would be a great move of $30 or something like that, and it would have got you in relatively early. Here is USO, and what we want to show you on this particular area is you can see how the price is actually struggling to make any moves higher. And even though %K keeps banging on the top here, the %D, which is the moving average, this purple area, is moving down and making a lower high here. And it's that lower high that is our divergent clue that we want to be aware of. And then that's going to give us our sell signal. And in this case, we've got double divergence with another lower high way over here. And that is a real clear signal that George Lane likes to talk about. When you get those, it's a very valuable signal. So you're looking for the divergence on the moving average. And again, in this case, I've set up all three as 5 period moving average, but our default is 14, so you could set them up whatever way you'd like. And the way you do that is just select them from the drop down menu in here, and then pick the time period that you want.